Hello, and welcome to Behind the Data with me, Glen Pereira. Today we are diving into key factors shaping the energy market since our last update at the end of September. Our top three drivers behind prices for October have been temperatures and wind conditions, geopolitical development, and liquefied natural gas, also known as LNG. As mentioned, our first key driver this month has been weather-related, and the temperature and wind together have played most influential role in shaping the energy market dynamics. Across UK and Northwest Europe, temperatures have consistently remained above seasonal norm. The milder weather has naturally reduced heating demand, keeping overall gas consumption relatively low. At the same time, wind generation has been quite variable. We have seen periods of strong output, followed by the occasional lulls. During the high wind periods, renewable power has displaced gas-fired generation, helping to suppress gas for power demand, driving day-ahead prices down as low as 50 pence per megawatt hour. When wind output did drop, the system remained well balanced, largely because of underlying weak demand driven by mild weather. As a result, despite fluctuation in wind generation, the overall impact on prices throughout October have been limited. The combination of above season norm temperatures, steady renewable output has created a comfortable supply and demand balance, keeping market volatility relatively contained. Our second key driver is geopolitics. Recently, European Union adopted its 19th package of sanctions, this time targeting Russian energy banks and cryptocurrencies. The new package introduced ban on imports of Russian LNG into EU. For long-term contracts, the ban will start in January 2027, while the short-term agreement must comply within 6 months. It also tightens restrictions on transaction with two major Russian state-owned oil producers, Rosneft and Gazprom. When this announcement came out, we saw some of the immediate market reaction, especially for contracts like Summer 26, which gained noticeable premium, mainly due to supply concerns, which led to a wave of panic buying. The latest sanction package is designed to sustain economic pressure on Russia, with broader objective of hastening an end to the conflict. Yet while Western nations tighten restriction, China has quietly moved to offset part of Russia's lost revenue streams. Recent data show that Beijing has resumed imports of sanctioned LNG, with 11 vessels have already berthed at the Beihai terminal. This development provided some relief to global LNG market as China increased intake of Russian supply reduces its demand in the soft spot market. The Beihai terminal has effectively become a Russian-only facility operating with limited exposure to Western oversight. Managed by China Oil and Gas Pipeline Network, the terminal faces minimal risk of US financial sanctions, given its limited involvement in dollar-denominated transactions. Following Russia's exclusion from the global dollar and euro payment network, China expanded the use of yuan in trade and cross-border settlements. As a result, the yuan has now overtaken US dollar as Russia's most traded foreign currencies. This shift has provided Moscow with a crucial financial lifeline, supporting ruble stability and maintaining import flows outside the Western banking system. Also adding to the overall downward movement in prices has been Israel-Gaza peace deal. This development removed a significant amount of risk premium from the markets and brought a renewed sense of optimism, especially with the Red Sea shipping routes reopening, which offered some much needed relief. And lastly, on the geopolitical front, the European Parliament has agreed to consider further changes to EU's corporate sustainability rules. This comes as both the US and Qatar have stepped up pressure on Brussels to weaken the legislation. They have warned that the current rules could disrupt LNG trade with Europe, a concern that's weighing on the policymakers as they look to balance sustainability goals with energy security. And our final driver is LNG. We have been seeing a strong influx of LNG vessels arriving in Europe, around 174 vessels so far, which is 28 more than the same time last year. There has been some concerns earlier in the week about Hurricane Melissa, which was tracking towards Gulf of Mexico, home to several major LNG export facilities. However, markets found some relief as forecasts now suggest that the storm is likely to avoid that region, easing fears of potential supply disruption. And finally, looking ahead at one key development to watch in November is the potential progress of US-China trade deal. As we know, China is one of the world's largest buyers of oil and gas, so any signs of breakthrough could boost industrial demand and lend support to prices as consumption grows. However, with the recent trade agreement with the US and Japan focused on rare earth materials, it appears Washington may be working to reduce its dependency on China. So whether this is part of a broader strategic move or simply a parallel negotiation, any developments between those two economic powerhouses will closely be watched and could play a significant role in shaping energy market sentiments moving forward. Thank you for listening, and I hope you found this update useful.